What if I told you the most boring thing you could possibly do with your money is also the thing that makes you the most of it? Like not crypto, not options trading, not some guy's Discord server where everyone calls each other bro and posts screenshots of green candles. We're talking about investing. Yeah, sounds boring. Nobody teaches you how boring to be. That's the actual gap. We're going to talk about that. Most people treat investing like it's a personality test. I'm a risk taker. Cool. You lost 40% in 6 months. I'm cautious. Cool. Inflation ate your savings account alive. Neither of those is a strategy. That's just a vibe. And vibes don't compound. Let me tell you what's actually happens to most people. You get a little extra money, maybe a bonus, maybe a tax return, and you think, okay, I should do something smart with this. So you open an app. You look at a few tickers. One of them is up 80% this year, and you think, gotcha, that's the one. You buy it and it drops immediately. Here's what those people are actually doing and end up flexing massive returns online. They just picked something that went up at that time. The market rewards reckless people just enough to make them think they've figured it out. Like, the real question isn't, how do I pick winning stocks? The real question is, what system still works even when I'm wrong? You've probably heard of index funds. Maybe you've nodded along when someone brought them up without totally knowing what they are. Let me break it down fast. An index fund is basically a basket. Hundreds, sometimes thousands, of different company stocks. When you buy one share of an index fund, you own a tiny sliver of all of them at once. Why does that matter? Because you stop betting on one horse. You bet on the entire race. Some companies in that basket will fail, but historically the whole basket has gone up about 10% per year on average. Not every year. Some years it drops, some years it soars, but zoom out over a decade, up. Almost always up. Every investment account, every fund, every ETF charges you a fee called an expense ratio. Most people never look at it. It's usually a tiny percentage, like 0.03% or 1.2%. Sounds close, right? It is not close. Let's say you invest $10,000. Over 30 years, a fund charging 0.03% in fees, you end up with roughly $76,000. Same money, same market, but a fund charging 1%? You walk away with about $43,000. Same investment, $33,000 difference. Gone, just in fees. Low-cost index funds, like ones from Vanguard, Fidelity, Schwab, charge almost nothing. Some literally charge zero. That's where you want to be. When the market feels weird, you probably wait until things calm down. The strategy isn't timing the market. It's time in the market, which means start now, not when it feels safe. It never fully feels safe. All right, let's make this concrete. Here's a setup so simple it almost feels wrong. 3 funds, that's it. 1, a total U.S. stock market index fund. Covers thousands of American companies all at once. 2, a total international stock market index fund. Because the U.S. isn't the whole world, and sometimes other markets do better. 3, a bond fund. Bonds are boring. They don't grow as fast, but they don't crash as hard either. Think of them as the shock absorber in your portfolio. That's the whole thing. You don't need a financial advisor's $500 course. 3 funds, low fees, keep adding money over time, don't panic sell when it dips. Your future self is basically begging you right now to just not panic sell. Start small, start now, stay boring, and I promise, in 10 years, you'll be glad you did.